So that's just a little catch up from the first class that we had. And now let's keep going and get some formal definitions in our notes about what micro and what macroeconomics is specifically. So I talked to you guys a little bit about this, and I use the analogy forest for the trees when we talk about macro, but a better analogy is to really talk about the whole ecosystem of a pond or a lake, right? So when we talk about macroeconomics, we are talking about the branch of economics that focuses on broad issues. These broad issues are things like growth. You know, how much growth do we need to sustain the growing wants and needs of our consumers, of our workers? Things like unemployment. What is causing unemployment? What is causing exceptionally low rates of unemployment, right? Which would be a more applicable question to the current situation. Inflation. How much inflation should we expect? How much is too much? And lastly, they talk a lot about the international dimension, because international trade has grown from being, 1% to 5% of our GDP to 15 to 20%, right? So trade balances. If we look at most of the clothes that we buy, definitely all of the shoes that we buy, a lot of the electronics that we buy, they're all produced abroad, right? So we are purchasing those, and that impacts our trade balance, which in turn has some far-reaching reverberations throughout the rest of the economy. Some very interesting things that we will talk about later when we get to those chapters. Right now, we're just trying to get a broad strokes impression of what's going on here, so we can identify which issues are macroeconomic and which issues are microeconomic. So microeconomic issues are going to be focused on the actions of individual agents. So this is like looking at a certain type of fish in the pond, or looking at the algae in the pond, or looking at, I'm running out of things that one finds in ponds. Frogs in the ponds, right? Every time you hear frogs, that's a good sign. That means that the water around you is not polluted, because frogs are some of the first, they're like canaries in the coal mine. They're some of the first things to die if the water's no good. So if you hear frogs, that means you got good water around you. It's a good sign. Anyways, random fact for the day. So this is the action of the individual agents, right? So this is going to be, when we talk about individual agents, who are we talking about? Well, we're talking about just you and I, individuals, right? But here's the thing. We don't make these decisions in a vacuum. And a lot of times we're making decisions that are impacting not just ourselves, right? They're impacting our parents. They might be impacting our siblings. They might be impacting our spouse. Right? They're definitely impacting our housemates or roommates or flatmates and things like that, right? And so when we talk about the action of different agents, not only are we talking about individuals, but we're also talking about households or family units. So in economics, we just group families and stuff like that into this term, households. And so sometimes we will model how a household reacts to something as opposed to how an individual consumer or individual worker reacts to it. We will look at how workers react to things. We'll look at how businesses react to things. And sometimes we'll even look at how governments react to things in microeconomics. So macro is zooming out, taking a look at the broader issues that usually have many elements of microeconomics in it. For a long time, macroeconomics fell prey to this problem of methodological individualism, which is a really, really fancy way of saying that the macroeconomists would assume that the way to model an economy is to use these microeconomic assumptions and build models based off of these microeconomic assumptions. Well, it turns out that really didn't work out well. We've kind of diverged into two distinct types of economic or scientific inquiry, so to speak. So when we're talking about macroeconomics in particular, I mean, really, when we're just doing any kind of economic analysis, right? It's not just good enough to identify and figure out what's going on. We also want to talk about what are some of the levers that we might be able to pull in order to influence the economy. And so two of the main levers when we're talking about macroeconomics are monetary and fiscal policy. So let's define those real quick. Monetary policy. So monetary policy is the first big kind of jargony word that we've got here. Triple equal sign just means it's defined as. So monetary policy, these are policies that involve altering the level of interest rates. So this is going to be things that increase or decrease the interest rates. Now, why do we care about the interest rates? Or rather, why does the Federal Reserve, who's the people that are in charge of the monetary policy for the United States, right, our central bank, why do they care about increasing or decreasing interest rates? Does anybody have any guesses about what decreasing interest rates might do? What could decreasing interest rates do to the economy?
Makes more people want to go take money out.
To do what?
Price.
To buy. So that's part of it. Yes. So when we think about big ticket items, like a car, like a boat, like a house, right? Let's say that the price of that stays equal. And this actually brings us to an important assumption in economics called ceteris paribus, which at some point we'll define. It's this notion of all else equal. So we assume that all else is staying equal. So let's assume that the price of the house stays the same at, 200,000, price of the boat's 100,000, price of the car is 50,000. Just easy, simple numbers, right? If the interest rates decrease, then the actual cost that you're going to be paying out of pocket for financing that same car that's $50,000 is going to go down. So that car is going to be cheaper, even though the actual price, the sticker price on it, hasn't changed a damn thing. The MSRP is still the exact same thing that it was before, but because the interest rates are lower, you're going to be paying less money out of your pocket to finance and purchase this big ticket item. So when interest rates decrease, that increases or stimulates these purchases of big ticket items like houses, cars, boats, so on and so forth. Now, let's think about businesses. So it's easy for us to think about these situations from the perspective of a consumer, right? We're used to that. But let's think about it from the perspective of a business. So these businesses, they make money and they retain profits so that they can expand for very interesting reasons, right? They may want to, instead of buying the bread or something like that, they may want to expand and bake the bread on site, right? And so they're going to make this expansion, and they do all this financial forecasting to figure out what's my return on investment. It's going to cost me $100,000 to build this, and I'm going to get, let's say 5% as a return on this thing. Well, when the interest rates are prohibitively high, right? If the interest rate is above 7%, then it just doesn't make sense for the business to go and do that expansion, right? It would make more sense for them to just passively invest that money in the market and get that 7% rate of return or whatever the case may be. Because regardless of how much they try to do a scenario analysis and look at base case, worst case, best case scenario for the projections of this expansion, there's still some risk involved there. Additionally, let's say that they don't have the money. Let's say that they have to borrow some money. Well, now it really doesn't make sense because now you're borrowing money at 7% to then make 5% back. So at the end of the day, you're going to be losing 2%, right? So a change in the interest rate is going to have a direct influence on the availability of credit. Which itself is going to have a direct influence on the extent of borrowing. And it's really through those three channels, through the households not buying being incentivized or disincentivized to buy big ticket items, by the businesses having an opportunity cost for their expansion funds, and also because of prohibited cost of capital. So when the interest rates increase, things that used to make sense 2 years ago, right, to have a 5% return, now no longer make sense because you're borrowing money instead of at 2% at 7%. So the monetary policy and the Federal Reserve can have some widespread, far-reaching influence on the economic activity of the consumers. The interesting thing about monetary policy is that it is not a part of Congress. This is not it's not a part of the executive branch, right? So, there's certain things that are parts of the executive branch, like the Consumer Financial Protection Bureau and the student loans. There's all sorts of stuff that's under the executive branch that's a bureaucracy. And in a way, it makes sense to have the Federal Reserve System under there, but here's why we don't do it that way. If we let the politicians be in charge of the monetary policy, they would juice the economy before an election. And they would essentially do things that are for the short-term benefit of the numbers, right? Because at the end of the day, especially when we look at presidential elections, the greatest indicator of whether or not an incumbent president is going to be reelected is whether the economy is doing well or not. Right? There's that whole Bill Clinton in the 90s, being like, it's the economy, stupid. And that is still true to this day. So if we look at the statistics of incumbent presidents and whether they get reelected, it has almost entirely to do with how well the economy is doing. And so if we let these policy tools be in the purview of that executive branch, well, then we're going to end up having a bad time. And this is actually what happened in Turkey recently. So President Erdogan over in Turkey has been essentially, pressuring and wielding the monetary policy himself. And as a result, Turkey has had, 20, 30% inflation rates for the last few years, and they haven't been able to get their inflation or their interest rates under control. So some autonomy for central banks is a good thing. That's what most economists writ large would agree with. All right, get off my soapbox. Okay, next type of lever that we have is our fiscal policy. So our fiscal policy, these are the policies that involve government spending and taxes. Let's do a better job with government. So some of our fiscal policy is autonomous, right? Some of it just happens. So if you become unemployed, you get unemployment insurance, right? If you hit 65 and you've paid enough into the system, you just get Social Security payments and Medicare and stuff like that. So some of it is just, it happens, which is great. We call those automatic stabilizers, because essentially when things are going downward, when we're in recessions or depressions, oftentimes we can't wait for the implementation lag of monetary or fiscal policy. So we have some things that are kind of automatic. They kind of just they trip and they end up help stabilizing the economy. We also have some policies that Congress has to deliberate on and take, right? So, one of the main ones in the last couple decades was the American Recovery, the ARRA Act that was in 2009, which I'm sure you all don't remember, but we had a big recession in 2008. The whole financial sector imploded. A bunch of people lost their houses. It was quite a catastrophe. The Federal Reserve had to come in and mop up all this really bad debt, and the federal government came in and stimulated the economy through really just pumping a bunch of money into public works projects and universities and so on and so forth. One of the ones that we will remember is the COVID injections, right? The COVID money that we all got. That was a fiscal policy to essentially ensure that we didn't go into a recession artificially. So fiscal policy is pulled out in times of emergencies, but also fiscal policy is part of a big part of fiscal policy is these automatic stabilizers. Questions on macro, micro, monetary, and fiscal policy. Again, I probably talked way too much about that stuff. We're going to get into it in more detail in the chapters that are going to follow, but I just, for those of you that are interested, I was trying to make it relevant. Questions, comments? All right, cool. So I'll stop that.